Okay, great. Let's begin. So, my name is Mark McNamee. I am the Director of Europe here, and I want to welcome you all to the DuckerFrontier webinar on Central and Eastern Europe's 2021 Outlook. Before we get started, just very quickly, we realize that some of you may be new to DuckerFrontier, so we'll just take one quick minute to provide you with an overview of our firm and how we work with executives at multinationals. DuckerFrontier is a leading market intelligence and consulting firm that provides tailored solutions to drive growth for clients across the consumer, B2B, healthcare, and tech sectors. Our dedicated teams serve as advisors to clients, delivering the market and industry knowledge they need to succeed at all points in the business cycle. Looking at our trusted partners here, this is not a comprehensive list, of course, but a number of our notable clients that have agreed to allow us to share their branding. With our continuous research and insights, custom solutions, and transaction support services, we provide our clients with timely, actionable insights to adapt and win in changing markets. Our company is headquartered in Washington, D.C., with offices in Troy, Michigan, New York, London, Paris, Berlin, Singapore, Shanghai, and Bangalore. For more information, of course, please visit our website at www.duckerfrontier.com. And also, as a quick reminder, for many of you, please download our mobile app so you can quickly and easily view and download all of our content from the convenience of your phone. Now, with that said, and having briefly introduced our company, I'd like to start the webinar and briefly introduce you to our panelists today. We have two members of our research team here on the line for today's call. The first is myself, of course, Mark McNamee. Many of you on the line have spoken with me in the past. Of course, I lead the research team for Europe here at DuckerFrontier with a specialty focus on Russia and CIS markets, and therefore we'll be sharing insights on some of the global and regional trends and our view, as well as our more specific outlook for the Russian and CIS markets. The second is Martin Belchev, who many of you have also spoken with, of course. Martin is the senior analyst for Central Europe and will be explaining how the region will see varying rates of recovery coming out of this coronavirus shock and the lockdowns. As Martin and I are, of course, in constant contact with our clients, we'll be discussing not only the results of our research and analysis, but also what we've been hearing from corporations like yourselves on the ground who are being impacted in real time by the coronavirus pandemic. And if there are any insights you see today as part of this discussion or any questions we don't get to answer, our client services team and Martin and I will be following up with you directly. So with that said, moving into the agenda here. Our webinar today will consist of a roughly 50-minute presentation followed by Q&A. I will walk through our view on the global and regional economic outlook and how it impacts our expectations for Central and Eastern Europe in 2021. Martin and I then will sort of tag team going through the view for the Central European markets as well as the major Russia and CIS markets, which will likewise include, as you can see here, a presentation of our recovery index and what it constitutes. Martin will then give a little bit more depth view on our Central European markets, as well as the assessment of the recoveries for those markets in Central Europe, alongside my views on Russia and CIS markets. This will all, of course, be followed up by an evaluation of generalized industry trends, as well as business implications, and then more of a quick but more focused look into the Belarus crisis, which many of you, of course, are managing at the moment. So with that said, let's get started on the presentation here. So to begin, just to define the region that we'll be speaking about today, of course, this is different. Many of you may have seen or attended our webinar a week ago today on Western Europe. This is, of course, different as we are now moving farther east, so covering the Central European countries of the Baltics, Poland, all the way down into the Balkans, and as well as Russia and CIS markets, so former Soviet countries, including Russia, that we'll be covering today. Of course, we're going to start off this presentation with a quick commentary on our view of how the pandemic will be progressing in the coming months and into 2021, and in particular concerns about a second wave. So a couple of quick points is that unlike what Donald Trump and numerous other politicians around the world have publicly stated, COVID will not just simply disappear on its own. This is simply a reality that all of these markets globally will be dealing with, at least until we get a vaccine as we anticipate, to be produced and distributed successfully around the world by the end of next year, with, of course, staged introduction into some of the most critical markets, particularly developed markets, at the beginning of next year and through the middle of next year. So a bit of an uptick back in those markets as the vaccine is developed. That said, until that time, the mask wearing, the social distancing measures, the threat of reimposed restrictions, as we've seen in numerous markets across Europe, will continue for about the next 9 months, 12 months, to be perfectly honest, with major implications, of course, on various sectors, and specifically the tourist sector, I would specify. So all of that said, there's a lot of concern about second waves, and I get this on a nearly daily basis as a question from clients. Our anticipation is that is a second wave with lockdowns similar to what the world saw in Q2 is extraordinarily unlikely. So that's the good news. Now, the negative news is that what we'll continue to see for about the next 9 months is what we've already seen in numerous markets, whether it be Germany or what's going on in Spain currently, or in Ukraine with an uptick in cases, is more temporary restrictions in certain sectors reimposed in certain parts of the country. But again, only temporarily, and with the expectation to be taken off, assuming that the healthcare system is not overburdened. So, of course, that's going to restrain sentiment in these markets and demand, but that is very, very different from the initial wave and the lockdowns that we saw in the second quarter of 2020. So that's in part, at least, good news. In terms of the economic impact, a lot of the issues that we saw in Q2, particularly because of the weak, spurred, of course, by the drop in production, industrial production, as well as the need for fiscal support, this has lingering consequences into 2021, and for some markets even into 2022 and maybe even 2023. But all this weak demand, the weak business demand, the impact on labor markets, the job losses, the wage cuts, all of this, of course, has really hurt sentiment for the long term. We've seen major improvements compared to Q2, but nonetheless, this still restrains sentiment. And then, of course, public spending was used in a massive way to help counteract the worst of the lockdowns. But those debts, of course, have to be paid. And so those stimulus measures are going to be removed. And that's a major point for your markets that you're watching. When will that fiscal support expire? So we'll talk more about that going forward, because in some cases that could be occurring in Q4 of this year, which then could incur significant problems on labor markets and demand into 2021. For these reasons, though, that's why we're seeing this sort of prolonged, gradual, just very gradual recovery since Q2 in most of these markets that we'll be discussing today, because there are lingering consequences that will continue to have ramifications, keeping unemployment slightly elevated, as an example, into the middle of next year for many of these markets. This, of course, holds back investor confidence, and so this leads to these slower recoveries, debt issues, which, of course, will restrain some government spending and support in certain areas of the economy. And of course, these will have political ramifications, as we've already seen in Belarus, and we'll discuss some other markets that could be touched by that. So the goal, of course, is to get back to where we were before COVID. Looking around the globe, the relatively speaking good news is that, first and foremost, China and Asia have actually revived back a little bit more strongly, frankly, than expected. We revised up some of our forecasts for several of those major markets, including China. But then also, I would highlight more specifically here, Central and Eastern Europe, relative to the rest of the world, will be performing a bit better. So we can say quite confidently for the next 18 months, for the next 24 months, the next 30 months, these markets will be consistently outperforming most regions, globally speaking, and most definitely within EMEA. So that's, of course, comes with risks and opportunities. On the risk side, that means headquarters is likely to put maybe some more pressure on the business to perform. But of course, the opportunity being that there is a considerable upside to take advantage of, relatively speaking, to a lot of the other regional markets, whether within EMEA or globally, that will be having a slower recovery back to 2019 demand levels. I also want to share a little bit of positive news. You can see here the yellow circles I have around a number of markets here. This actually indicates our rising optimism for the global economy as we have revised up some of these key global markets. I highlighted Poland, not a key global market, but of course within this portfolio, a key market. We revised up actually our forecast for 2020 and 2021 for these markets here, which is good news for commodity prices in particular, which we'll talk about next. But I do want to highlight though, again, Central Europe outperforming most of these major markets. In Q2, Russia only had a drop in GDP of 8%. Relatively speaking, that's quite solid. Poland also quite solid in the second quarter. Germany considerably weaker, and Germany performed better than most markets in Western Europe. The United States, of course, quite weak as well. Italy, UK, very weak second quarters. So the point being here that Central Europe will be quite appealing as it's been more resilient already this year and will be bouncing back a bit stronger than most markets next year. So good news for the region and your markets you're covering here. Related to oil prices, I had mentioned with this sort of global recovery, oil prices have actually helped on the demand side, at least. We've seen oil prices recovering, frankly speaking, well beyond consensus expectations. So for the last 3 months, oil prices have been far higher than what most forecasters, including ourselves, had anticipated, which is quite good news, of course, for those energy exporters like, say, Russia or Kazakhstan. This should continue. We've seen oil prices come back down a bit just over the last couple of weeks, as we've seen a little bit of weakness in some global demand, but we do anticipate energy prices to revive towards the end of the year. And then, as you can see from our forecast for 2021, revive much more clearly and decisively over the course of 2021 as the global economy strengthens. Moving on also, of course, to another major global dimension as it impacts particularly European markets as well as Russian CIS markets are the coming US elections in November, so less than 2 months from today. As you can see here, we've actually altered our view for the US elections, which earlier at the beginning of the year we had expected Trump to win, and now as a result of Trump's management of the COVID pandemic in the US, as well as the racial tensions in the US, we've seen his popularity, as you can see, falling quite consistently. Biden's popularity, as of even the latest polls this month in September, have remained around plus 9%. So his popularity is still holding, though it's a bit weaker than earlier. Another reason we're expecting Biden to win is because, unlike in 2016 when Trump surprised Clinton, you can see after the conventions there was a lot of undecided voters in 2016 after both the Republican and Democratic conventions. This year there are far less undecided voters after both conventions took place in August of this year. So that gives Trump a little bit less potential to take some votes surprisingly at the end and have a surprise comeback. Nonetheless, it is going to be a very close vote, and the point here being is that with our expectation of a Biden victory, this is good for Central Europe insofar as we believe that some of the tariffs and some of the trade tensions that have arisen during Trump's term will be removed under Biden, which will then help trade with Western European markets and then have a second order critical positive impact on Central European markets. However, on the other hand, this would also likely incur harsh sanctions against Russia in the first half of next year, which means more ruble depreciation, and that has, of course, spillover impacts onto all the other markets within the CIS, in particular through currency impacts. So that unfortunately would hold back some demand in the CIS region. We also wanted to highlight here mobility trends that we've seen in these markets, and another reason why with the response to COVID we're seeing a bit of a better recovery in some of the markets that we'll be discussing today in the CEE region as a whole. So you can see mobility, of course, dropped dramatically during the lockdowns, March, April, May, and even into June, quite weak. However, Russia, Ukraine, and the CEE region as a whole have consistently really been recovering faster than most of Western Europe, and in particular France and the UK, who are still lagging behind earlier levels, so prior to February. So this is very good, of course, for demand, confidence, people's willingness to spend, go out on the street. Whether it's healthy or not is a separate question, but it is good for demand, of course. And then the impact on currencies. So as we've seen since the pandemic, so since March, all currencies against the dollar weakened quite considerably. That said, since that time, all these currencies have bounced back to varying degrees. Central European currencies, as you can see, the Polish zloty, the Hungarian forint, the Romanian leu, have actually continued to strengthen and have remained quite resilient against the euro as well. This trend should continue. We shouldn't see massive more strengthening, but we should see continued strengthening along this trend that we've already seen consistent now, really for about the past 4 to 5 months. On the other hand, you could see the ruble, the hryvnia, and the tenge weakening actually. So strengthening from their very low points in March, but then weakening again the last couple of months as a result of several factors which we'll discuss in the future. But nonetheless, you can see our US dollar rates for these currencies moving into next year. There's some divergence here. CIS markets, we're seeing more depreciation across the board. Sanctions coming. The central bank in Ukraine is insistent upon weakening the hryvnia to help exporters, and the tenge follows closely the ruble typically. So we're seeing depreciation in those markets. So something to definitely be paying attention to, consider hedging strategies. Well, on the other hand, with the Central European major currencies, a clear trend of strengthening. Likewise against the euro, depreciation in CIS markets, whereas you see a little bit more stability, but also some strengthening of the Central European currencies. So all of that said, kind of having given the global and regional view of things, we can talk more directly then about COVID's impact in this region. And before we get into that, I do want to pose a polling question, which we'll open up here now, and I'd like you to respond to this question in terms of your primary way of increasing profitability in 2021. Obviously, it's a very difficult prospect at the moment, naturally in light of all the pressures on the business, but of course, headquarters is looking for an increase in profit nonetheless. So I would appreciate your answer to this question, and then we'll review the results. Okay, unfortunately, I'm unable to see the polling results. One second, we have a tech issue. Let's see if we can resolve this. Okay, well, I can't present the results, but I'm able to see them offline here. So we will send this along, so you'll be able to see the results after the webinar here. But nonetheless, in terms of the results, we see actually a varied strategy here. So the most popular answer, around 40%, was reducing operational costs. So that's obviously a quite difficult prospect to be doing. So it makes your jobs naturally harder instead of seeing just simply increasing sales volumes. But nonetheless, we also see as a second most popular answer, focusing on high margin customer products and segments. So more in-depth segmentation strategies in the region, which also we think makes sense because there's a lot of trading down this year, but fundamentally we think there's going to be a considerable amount of deferred demand into next year. And as confidence resumes, unemployment goes down, incomes go back up. We believe that consumers in particular, and businesses of course, but consumers in particular will want to return to their previous spending habits of 2019. So I think that does make sense. And then lastly, at 25% was increasing sales volumes. So I think that those are quite interesting results to take. So moving on, in terms of our growth forecasts here, I will hand it over to Martin to give you a little bit more depth of our view.
Thank you, Mark. So as we already highlighted, the CE region as a whole remains quite attractive in terms of size of the opportunity, but also how resilient it has been and how likely it is to rebound next year, especially when compared into the broader EMEA portfolio. So the key point is that what we are seeing is that markets in the region will be less impacted by the COVID crisis in 2020, and we'll see a more resilient rebound going forward into 2021, which will create some new opportunities for MNCs. Now, with that being said, it's very important to also point out that there is also a very strong disparity between markets, and this is why focusing on specific market subsegments in 2021 that will be outperforming definitely makes quite a lot of sense. So just to highlight a few more notable examples. So we have Croatia being a definite underperformer, and this can be attributed to the market's high reliance on tourism and high exposure to what's going on currently. So even though we see a relatively sharp rebound going forward, this is more of a statistical effect rather than an actual return of the opportunity back to 2019 numbers. On the other hand, we have markets such as Kazakhstan, Serbia, Lithuania, and Poland that will see a much softer impact this year, and at the same time a very notable rebound going forward into 2021. Now, this disparity can actually be is quite noticeable when we talk about the size of the fiscal stimulus that these markets have implemented in 2020, and this is something that will drive this pace of recovery going forward. So, not surprisingly, markets that are more resilient, such as Serbia, Poland, Lithuania, have seen a relatively large direct fiscal stimulus in their economies. An important point to also make on this is that a lot of this fiscal stimulus have went to protecting jobs, protecting employment, which has also softened some of the initial shock to these economies. However, as Mark highlighted earlier, it's important to monitor how will these wage subsidies be phased out in the upcoming months to anticipate an uptick in unemployment, some hit to real wages, and its effect on consumer spending. So, in short, it's not over. It's not over yet. Turning towards 2021, what we've seen for Central European markets specifically is that as a result of this direct spending in the economy, budgets have obviously seen rising public deficit. However, the recently announced EU Recovery Fund and the EU Cohesion Fund and size as a percentage of GDP for these markets is quite notable, and this will pave way for this resilient recovery and rebound going forward, especially when it comes to higher public investments, which will also support the labor market in 2021 and going forward. Another important point is that a lot of this funding under the EU Recovery Fund will actually be funded into these markets in 2021 and 2022, as you can see on the graph we have here. And markets that have been severely impacted by the ongoing COVID crisis, such as Croatia and Bulgaria, will benefit greatly from these grants and really interest-free loans, which will again support this resilient recovery, new opportunities, and uptick in public investments.
Great, and I do want to highlight on the after having spoken about Central Europe, we are seeing diverging trends again. We already talked about currency performance being a bit different into next year. Likewise, Russia is going to sort of return to its more traditional, historic, austere government spending policies, like we had seen over the last several years until about 2019 and early 2020. Russia now, after having increased spending, of course, for this year, is planning to cut spending for the next 3 years. That is a 10% cut across 50 undisclosed budget categories. What seems relatively clear, though, is that these cuts will not be necessarily impacting social spending, which is absolutely critical, of course, to the Kremlin's political support, but we will see cuts in defense spending in this form here of state arms procurement, as well as canceled indexation of public salaries. Now, that's quite important in terms of demand in the country, since public employment is such a large share of total employment in the nation. So canceling that indexation of public salaries, yes, it's only a couple percentage points of inflation, but that does mean incomes are not growing as much as they could, which is quite critical. Plus a delay in the national projects, which means by pushing back a lot of that spending, a lot of B2B demand that could have been there, maybe a little bit weaker. A lot of construction demand that could have been there will be a bit weaker, unfortunately. But nonetheless, we are seeing, of course, reviving growth in Russia, but the state at this point is indicating that it is unwilling to continue with a lot of the stimulus that other countries are likely to continue with into next year, and in particular some Central European countries, as Martin showed. I would highlight, as we indicated at the beginning, how critical some of this government spending will be, particularly in the next, say, 30 days or 2 months. In a number of the markets, including Russia here, we are seeing the expiration of a lot of these fiscal support measures in the beginning of October, whether that's loan deferrals on loan repayments or tax deferrals, moratorium on bankruptcies, particularly in the case of Russia. This will be occurring in the next really 30 to 60 days in a number of these markets, so pay close attention to this, because decisions of rolling over and continuing some of these measures will be absolutely critical to supporting businesses, of course, business reinvestment, and therefore ability to maintain employment levels and increase salaries into next year. Without that support, we could see another downturn, which then in turn would cause us to downgrade some of our forecasts. So very important times coming up here in Q4, and a lot of question marks around the corner. So with that said, looking kind of at a more granular look at some of the major markets and their bounce back here. As we had mentioned, Croatia will be bouncing it back a bit slower because of its exposure to tourism. But we are seeing, of course, Kazakhstan, as shown on the earlier slide, coming back a bit earlier and a bit stronger than most of the markets in the region, which will continue for several years. Likewise, Ukraine, Russia, bouncing back with some relative strength, showing some resilience back into 2021 and 2022. But Poland, Serbia, and Kazakhstan will be leading the region with the quickest recoveries in the region. And I do want to emphasize, we've made all these forecasts based upon an index, which we are now going to demonstrate to you the components of that index, which have guided our forecasts along. So first and foremost, and again, these slides will be available to everyone on this call, so you can review this with more depth, but we took into account a number of factors, both on the epidemiological side, of course, the duration of the lockdowns being the most impactful, as well as on the economic profile side of things. So fiscal support, in particular, the direct fiscal measures that Martin mentioned, monetary support as well, and then, of course, the exposure of these countries. Countries more exposed to, say, tourism or with a larger service sector, of course, would suffer more amid these lockdowns compared to ones that do not have large service sector or tourist sectors. So with that in mind, having taken a number of these primary factors and then ranked them across the region against each other, relatively speaking, we were then able to come up with our assessments of relative levels of exposure. So if you look at the far right column, so certain countries, of course, low, moderate to high. The good news here is that in terms of levels of exposure across all of Europe, Central European and CIS markets compare quite favorably when you're looking at the entirety of the Europe portfolio. So Central Europe and Eastern Europe will be bouncing back a little bit more strongly, and is also being a bit more resilient this year compared to most of your major markets in the Western Europe portfolio. And as you can see, this reflects naturally the bounce back of when we're getting back to pre-COVID 2019 GDP levels. So you can see most of these markets are actually low or moderately impacted, which means we'll see a recovery in the second half of next year or in the first half of 2022. Now, going into a bit more depth there, looking at first at sort of what we see as the stronger opportunities. So you can see from sort of left to right the strength of the resilience. So obviously Serbia, Lithuania, Poland not falling by quite as much as some of these other markets, but these are all more opportunistic markets for this year and next. I would highlight Russia in particular. Russia is, compared to most major EMEA markets, broadly speaking, is actually one of the more resilient of the markets. High public sector unemployment, high public sector employment, which meant that wages were allowed to continue to grow for those critical months during Q2. Also, unemployment never got particularly high, and then the fact that the economy isn't very service sector based or has a lot of small, medium enterprises. This has helped keep the Russian economy a bit more resilient this year. That said, it is going to, of course, not rebound particularly strongly next year, as you can see, in light of the inherent structural factors that have been holding back Russia's growth, frankly, for the last 10 years. So for those reasons, we still see it as a high opportunity market, particularly in light of its, of course, massive size within the CEE portfolio. In addition, Ukraine, I've heard from numerous clients, particularly consumer goods oriented clients, that Ukraine has been one of the best performing markets in the entire Europe portfolio in the first half of this year. And that actually does make some sense in light of how wages continue to perform throughout this entire year, really through July. And remittances never really collapsed to the level that that a lot of onlookers were concerned about. So remittances have been more resilient as well, which are absolutely critical to spending in the market. So for those reasons, this is fundamentally why we see these markets as a little bit more opportunistic going into next year. And I'll hand it over to Martin to give you a bit more of an explanation on those Central European markets, which are outperforming.
Thank you, Mark. So Poland actually will be one of the top performers going forward, and there are really solid macroeconomic reasons why this is the case. First of all, a large proportion of domestic industrial production actually serves the domestic market, meaning that those dynamics favor a consumer demand-led recovery. Second is the fact that the government has implemented a very ambitious fiscal package to support the economy, which has managed to already soften some of the impact that the COVID crisis has had. And the third reason is that really Poland will benefit quite significantly from the influx of EU recovery funding and new investments going forward, which will fuel this recovery and help stabilize the labor market going forward. Now, when we talk about moderate opportunity markets in terms of our index, there are several notable cases here. First one is Bulgaria, Hungary, Romania, and what drives this moderate opportunity in those markets is the very structural foundations of these markets. So in terms of Bulgaria, for example, we have relatively high fiscal spending, which however has been delayed because of the election period. However, the economy still has a relatively large tourist sector, and the fact that we have high policy and predictability at the moment really weighs on the outlook. In Hungary, even though we have a sophisticated manufacturing industry and strong fiscal support, the market is just too reliant on external demand, which, even though it will rebound going forward and this will drive the economy, it still is a massive weight on the market at the present. In Romania, we do have a relatively strong domestic demand dynamics. Consumer behavior is seeing a quicker return to normality. However, the market's high reliance on automotive and the tourist industries that have been quite impacted by the COVID outbreak continue to be a drag on these economies. And just as a final note, I would say that all of these three markets can be characterized by relatively low fiscal sustainability, which might necessitate some fiscal corrections going forward, despite this aforementioned influx of EU funding. And we talk about lower opportunity countries. We'll focus typically on Croatia, Slovakia, and the Czech Republic. And the reason why these countries fall under this lower opportunity bracket is in Croatia, tourism is just more than 24% of GDP, which will drive which has already driven the economy into a very pronounced contraction and a very slow recovery, which will only pick up in mid-2021. In Slovakia and the Czech Republic, market dynamics are notably different than Slovakia, but they play out in a similar way when it comes to the numbers. And the problem with those markets is that despite having solid fiscal support, especially for the labor market, these markets over reliance on the automotive industry and the fact that they already saw some slowdown in 2019 as they were losing out some of their competitiveness to the other of their peers, means that really this reliance on automotive exports will restrain the pace of the recovery. And even though we'll see a rebound in 2021, a lot of it will be more of a statistical effect as the automotive industry picks up gradually over time. When we talk about this divergence of recovery and subsegments, not only in markets, but also when it comes to specific sub-industries, it's also important to be mindful of the timing of when these industries will recover and how will this impact B2B demand and B2C demand as well. So this is a very broad overview of industries across the region, and obviously everything depends on a market-by-market basis. But just speaking broadly, the timing of the recovery again is very divergent, and we see industries such as retail, FMCG, telecommunications, agriculture, and pharmaceuticals seeing a much stronger and resilient rebound going forward at a much quicker pace than other industries. On the I guess bad news side, we see industries such as manufacturing still lagging behind a bit, mostly because of these domestic and external demand dynamics that are playing out from the Eurozone as well. Much more pressure on financial services, and obviously one of the most impacted sectors in the region, hospitality and tourism, seeing a much steeper slowdown and a much milder recovery than other industrial segments.
That's just to stay here. We get lots of questions, of course, on the tourism sector, since of course many of the clients on here sell to the tourism sector directly as consumers, but also B2B firms relying on tourism infrastructure and development. In terms of tourism, we expect actually a pretty quick resurgence once countries are confident to remove some of these restrictions, open up borders more confidently and permanently. There's a lot of pent-up demand to be traveling. So we expect in the second half of next year, as borders start opening up, as herd immunity builds from hopefully distribution of the vaccine, we could see tourism start to rebound initially very strongly for a period of months. We would expect in the second half of, in say Q3 of next year. And then of course level out for seasonal reasons, but then also for sort of the population having gotten to at least travel once again. So you should be preparing for probably a pretty sharp resurgence in demand at that time. So looking more broadly at the consumer sector, so in terms of retail sales, now again, a good piece of news. If I were to show these retail sales against, for example, what we showed last week with our Western Europe webinar, retail sales, yes, they fell in April as they did nearly everywhere in the world, but they fell far less sharply than they did in most of the major markets in Western Europe, not to mention many other markets, say in Latin America or in Middle East or Africa. So Central and Eastern Europe, again, being more resilient on the consumer side than most markets. Likewise, the bounce back has been more consistent and stronger than elsewhere. And we anticipate, likewise, this to continue going forward into next year. That said, a couple of quick things. For example, Russia here looks relatively weak. Again, compared to most major markets within EMEA, this is actually relatively solid performance and has exceeded expectations. Going ahead, as we look into sales, historically in August and September, and looking to Q4, we don't expect this considerable resurgence that we saw in June and July to continue apace as it has. A lot of this had to do with deferred demand that had been pent up in March, April, and May. And we're already seeing some indications of some soft sales growth in August and in September in a number of these markets. Of course, going forward, we don't also anticipate a quick resurgence, say in October or November, and probably you'll have to wait until the holidays to see another nice, clear, healthy uptick in spending. So the months ahead may be gradual improvements, but we could see a lot of plateauing of consumer demand. And again, pay attention, as I had mentioned earlier, to the extensions or expiration of some of the fiscal support measures and the impact they could have on business reinvestment, unemployment, and wages in the next several months, which of course would then set up for the recovery further down the road in H1 of 2021. And then in terms of business impact, I do want to just stay here for a quick second in terms of product offering. So this really puts more pressure on what are your new segments in the post-COVID environment. Now that we're starting to see the dust settle and the shifting sands now becoming a little bit more clear, what does your product portfolio look like based upon how your segments have altered as a result of the last 6 months and the COVID pandemic and lockdowns and the impact on labor markets and on consumer confidence. So something to be paying attention to, and very critically, to be working very closely with your retailers as well as your distributors in assessing how those segments have shifted, and segments geographical, but also income segments. So be paying attention to that, particularly as there's so much pressure, it seems, on being profitable next year by targeting those premium segments and those premium customers. Understanding how those premium customers operate in next year will obviously be critical to your growth, to your profitability, more specifically. And then related to consumer confidence, of course, driving some of that. So the reasons I gave the outlook I just did regarding retail sales expectations for, say, September, for October, for November, and into the end of the year, has a lot to do with the confidence levels that you can see here on this chart. So you can see in many cases, consumer confidence, of course, rebounded from April, from those lows, but we are still seeing it plateauing here into August, and not really near even the levels that it had been at the beginning of the year in Q1. So this is part of the reason why a lot of the resurgence in demand is probably more related to deferred demand, some pent-up demand, and then we're going to see some more moderation in September and October and November, likely uptick hopefully into the holiday season. But be very aware, of course, with these confidence levels, of a considerable amount of trading down into early next year as well. And mind you, this is better data than we're seeing in other regions. So despite some of this trading down, some of this hesitancy you're seeing in your region, it's worse in other regions. And so you'll be feeling some pressure from headquarters as well to perform, despite some of this relatively speaking weak confidence in the region. Martin?
Just speaking about reaching out to consumers and consumer channels, we just spent a couple more minutes on the tourism outlook, and just I'll start by saying that the fact that the tourist sector is a relatively small part of CE economies, you can see in Romania, Russia, Poland, we have this dynamic where these markets are much more resilient than what we've seen in, let's say, Western Europe, where you have Greece and Spain having massive amounts of tourism as percentage of GDP, their economy, making them much more vulnerable. There are a few notable exceptions, such as Croatia, Bulgaria, but the main point here is that, as Mark mentioned earlier, we do see the tourism sector being relatively remaining offline as throughout the rest of the year and the beginning of next year. And once we see fall of travel restrictions, the introduction of a vaccine, we then might see a rapid resurgence of tourist visits across these markets. In terms of business planning and just how that impacts consumer demand, we'll just summarize it by saying that you should plan for weaker demand in FMCG goods in tourist-based economies such as Croatia, Bulgaria, and much more stable demand in industrialized markets such as Hungary, Poland, and Russia. Another consumer channel worth discussing, and this has been coming up in a lot of conversations that we've had with clients on the matter, is really how the COVID outbreak has reshaped e-commerce trends across the region. So I'll start by saying that we've already seen e-commerce sales growing way above headline retail sales throughout the region, really, including CIS markets and Central and Eastern Europe. However, as the lockdowns were implemented, we've seen massive shifts towards these e-commerce channels in April and May. The main takeaway from these trends, and this is really can be seen on a global level, is that typically CE consumers have been a bit more hesitant to turn to these e-commerce channels. They have been more reluctant, especially when it comes to consumers that are older. However, as these trends have occurred, we've seen consumers being much more comfortable with going to these e-commerce channel and really tapping into these opportunities. So it will be that outbreak has led to a permanent shift in consumer behavior.
Great. So with that said, I'd like to open up another round of polling here. So if you could just briefly answer, what percentage of your firm's forecasted total sales in 2021 will come from e-commerce? Now, some of you who are in the middle of budget planning, so maybe you don't have this number off the top of your head, feel free to answer it for 2020 as well. But it'd be interesting to see how much we've seen an increase compared to previous years of total sales. And I already anticipate that many of the B2B firms on this call will, of course, be answering quite a low number here, but we can sort of dissect that once we get the results in. Okay, need to see the results. Okay, so what we can see here is that 52% said under 5%. So I would anticipate when we look through the attendees that probably a lot of these were B2B firms. But then we do have about 24% at between 10 and 15%. And then we have 10% at 15 to 20% and 10% at more than 20%. So over 10% of sales coming from e-commerce. That actually makes sense, I would say. Russia is probably on the lower end of that in general, but probably a bit higher for some of the Central European markets. But a considerable pickup, though, most definitely compared to the last 2 to 3 years. And then a quick word on B2B demand. And then, of course, please remember to submit any questions you may have. We have a couple of questions that we've seen, but feel free to submit any questions you may have so we can address those after we talk about some B2B trends that we're seeing. So looking at some of the major markets here in terms of industrial production, again, we're seeing naturally since the lockdown a resurgence of business activity, broadly speaking. That said, we did see more more disruption from the pandemic and the lockdowns in Q2 in Central Europe. And that's mostly the result of course, the severe drop in demand from Western European countries with which they trade more, and then also specifically the massive downturn in the auto sector, which sort of disproportionately impacts Central European markets. That said, we did see, of course, a downturn in industrial activity in Russia and Ukraine. The surprising point here is that Russia actually performed far better than these markets, comparatively speaking, and that's also taking into account the severe drop in oil and gas production as a result of compliance with OPEC cuts, with the new OPEC agreement at the beginning of April. So manufacturing production actually within Russia has revived relatively solidly since the end of the lockdowns. Ukraine, frankly, most of this downturn has to do with structural issues. Ukraine's amount of exports to China really held back industrial production in 2019 in particular, as China had a particularly weak 2018 and 2019. And Ukraine's industrial production has already been held back structurally, declining even prior to entering the pandemic here, and also will be slow to revive. So unfortunately, while consumer demand within Ukraine is picking up quite solidly, on the business side, B2B demand is likely to remain relatively restrained, and corporate credit likewise is quite weak in Ukraine. So I don't know if Martin, you want to add any more color on some of the Central European markets?
Indeed. So as Mark pointed out, Russia has been performing better, but we see this sharp drop in April because of the lockdowns and the fact that many factories across these markets stopped operating. However, as these lockdowns have been eased, factories have resumed to work, and we're seeing this increase in activity and in output. And this will actually continue very likely throughout the rest of the year, and we'll see a much more pronounced uptick in 2021 as external demand resumes and as domestic demand becomes a bit more resilient, and we see this reversal of employment losses.
Great. And then Martin, if you could just walk through this slide quickly, and then we'll move on to some final comments on Belarus and Russia.
Yes, indeed. So when we speak about industrial production, we obviously mean the broad indicator, but again, it's very important to focus on sub-segments and to see which specific sub-industries are performing better and will be much more resilient. So in this sense, we've seen industries such as the pharmaceutical industries being much more resilient, food processing and beverages as well, managing to keep some of their previous momentum going on. With this being said, even though we do see some very sharp contractions throughout industries such as vehicle manufacturing, transport equipment, nevertheless, these markets have still performed better than developed markets, and this is really paving the way for this recovery going forward.
Great. So we have a couple questions, so we'll get to those in a minute, but I do want to just quickly address of course, the crisis in Belarus, which has been ongoing since the beginning of August upon the elections, which the protesters, of course, accused the government of falsifying. And of course, this is quite a tense moment in the country's history, and has naturally geopolitical implications with as discussions with clients that I've had raises concerns about what Ukraine went through and the Maidan in 2013, 2014, and then subsequent to that. So in short, looking at our view here, just to give a very sort of brief overview, and I'm happy to take further questions if you're interested. The country is currently at a stalemate. The protest movement has proven its resilience. President Lukashenko and his regime have lost all domestic legitimacy, while also having lost the legitimacy of the West. And frankly, despite, of course, the meeting between Putin and Lukashenko in Sochi on Monday, he's also lost the legitimacy with the Kremlin. So currently, Lukashenko is more or less useful for the moment to Russia, but that is likely to be a temporary trend. As we anticipate, Lukashenko will be able to remain in power for very likely a matter of months. It could even potentially be, say, another year. But the crisis will eventually be broken by either rising macroeconomic instability, which we started to see, as you can see in the chart here, with the currency depreciation, and related to Kremlin's involvement and their choice of how they intend to influence the situation. As you can see here in the chart, very clear economic impact of the Kremlin's political decision, with the Kremlin willing to continue to support Lukashenko to at least a limited degree, and they've recently agreed upon a $1.5 billion loan to the Belarusian government. This actually helped the Belarusian ruble climb back a little bit, so appreciate a little bit over the last couple of days. That's of course good news for macroeconomic stability, of course for restraining inflation and keeping up demand in the market. Nonetheless, this situation cannot continue indefinitely as it is. So our anticipation is that Lukashenko will be removed from power. This could be several months even down the road. As a sort of, and I don't like to compare the situation too much to Ukraine, but as an analogy, the Ukrainian Maidan protests began in late 2013, and the situation really, Yanukovych was really only pushed out towards the end of February of 2014. So this could continue for several months along those lines, just to give a historical rough analogy. Now, what does it matter for business? We can talk about politics forever. We can talk about potential scenarios, how this develops over time. Of course, there's lots of risks for how this does develop in the future. Black swan events. Lukashenko decides to get far more violent with protesters, even shoot on the protesters, as we saw with the Ukrainian Maidan. Any number of events, of course, could take things in a different direction from what I've just outlined here. Nonetheless, in terms of the business impact for the next, say, 3 months or 6 months or so, obviously watch out for the risk of massive Belarusian ruble depreciation. If the Kremlin chooses to no longer want to back Lukashenko, we could see the ruble depreciating. So just a lot of uncertainty in the market. I doubt that Kremlin would take that path. It's not in their interest, but nonetheless, that is a potential risk and would have severe ramifications on demand and your operations in the country. As far as the spillover impact into Russia, which is a question I've been getting a lot from clients as well, is of course ruble depreciation, which we've already seen. So in light of course, the Khabarovsk protests in the Far East, the Navalny situation, and now the Belarusian crisis, we've seen the ruble over the last month depreciate quite considerably. This, of course, has influenced producer prices. So this could drive up some inflation, so more pressure on your distributors, on retailers, on your other local partners in the market. So that's on sort of the demand side. On the executional side, we could see some more ruble depreciation towards the end of the year. More worrying, though, is the potential spillover impact on the very critical Duma elections in 2021 in Russia. The Duma elections are set for September of next year. There's been a lot of chatter on Telegram that they could be potentially moved up to March of next year, so keep your eye out for that. But the concern, of course, from Moscow's point of view is the risk of spillover effect from Belarus into Russia from these protests in Belarus. Of course, it's completely unknown how that could develop, but we don't necessarily anticipate much of a spillover effect in terms of the protest movement, but this is simply what the Kremlin is of course most concerned about. So what we saw actually this past Sunday with the regional elections in Russia, which generally speaking we did see some improvements for the opposition, but generally speaking we saw the Kremlin more or less satisfied with the results of the regional elections from this past weekend. This is seen by the Kremlin as more or less a test run of how the elections could proceed in the Duma next year. And as they had gone this past weekend, this is the Kremlin's hope that they could then proceed into next year as well, avoiding major protests, avoiding major disruptions to the political dynamic in the country. And very critically, the Kremlin has introduced some other parties that are aligned with the Kremlin but are not called United Russia. And this strategy has been beneficial for the Kremlin, as we saw in the results of the regional election this past weekend. So that said, we have time for a couple of questions. Again, if there's any questions you have, please submit them. But otherwise, we do have a couple of questions that have come up. So, okay, so having spoken about the political implications for Russia and Belarus in this post-COVID environment, this question is for you, Martin. What would be some possible major political impacts of the COVID crisis in Central Europe, say into next year and beyond?
Thank you for the question. I'll first start by saying that the region remains very politically stable, and what we saw in 2020 is really populist movement just solidifying their grip on power. However, there is some uncertainty, and I would like to highlight the upcoming elections in Romania in December this year, which we expect the Liberals to win. But the reason why those elections are important is because they will pave the way for very necessary fiscal consolidations going forward, and just businesses and the market need some more assurances that the government can sustain their fiscal policies and that they see some stability and predictability going forward.
Great. Okay. Thank you. I have another question here just about second wave concerns and related to vaccine movements, and I'm sure that implies also vaccine development in Russia as well. Just very quickly, just to reiterate, we think it's extremely unlikely to see a second wave similar to what we had seen, say, in the first half of this year, and then even more unlikely would be the lockdowns that we saw to that extent in Q2. We know more about the virus, the rate of its transmission, the demographic it attacks, its fatality rates, etc. So it makes it highly unlikely we would see the type of lockdowns that we saw, and instead we'll see reimposed restrictions on a temporary basis in certain areas of certain countries at certain times, periodically over the next 9 months or so, which unfortunately has implications on demand, as we'll see continued restrictions on social distancing, limits on the amount of people in clubs and restaurants, etc., etc. So second wave is quite likely. Is quite unlikely and something you frankly should not be planning into your base case scenarios for 2021. So that's it for questions. I think that covers our entire presentation here. Thank you for those who submitted questions. And aside from that, Martin and I would like to thank you for sticking on the line for this hour. We will, of course, as mentioned, make this webinar, the deck, as well as this presentation available to you on our website, so you can review the polling results as well. So thank you very much for your time and have a great rest of your week. Take care.